Good Wednesday morning. I'm Yahoo Finance Executive Editor Brian Sozzi, and this is Opening Bid. Allow me to set the scene on what you are seeing in markets 7 days into the new year. The S&P 500 is near a record. The NASDAQ near a record. The Dow Jones Industrial Average is knocking on the door of breaking through 50,000 for the first time. Wow, OMG. That prompted me to post this on my LinkedIn feed last night. Where are you having your Dow 50K party? Valid question that ultimately led to my friend asking me if the Dow rally was solely based off of massive AI investments and all that excitement. I thought about it for a second and thought, well, hell no. There's more going on than just AI captivating the minds and portfolios of investors. So here's the simplest set of reasons why stocks are rocking right now. Reason one, fiscal stimulus stands to boost consumer spending in the first half of the year. Policy changes under the One Big Beautiful Bill Act have consumers in a position to see higher tax refunds this spring. Key bank analysts estimate that higher tax refunds alone could add as much as 2% to 4% to retail sales in the first half of the year. Consumer spending is the lifeblood of the economy, not AI chatbots. Reason two, we have entered the year with lower interest rates versus 2025, which could help jumpstart the U.S. housing market. Lower interest rates stand to also bring down rates on financing by retailers, also aiding the consumer. Reason three, there remains a good deal of uncertainty on tariffs by the Trump administration as the Supreme Court could rule soon on their legality. Arguments in November suggested the court was skeptical the president had authority to impose the tariffs under a 1977 law that offers special powers during emergency situations. If tariffs are rolled back, as the market may be betting on now, it could be a lift to corporate profits. The only question worth asking today is how long these feel-good vibes in markets could last. Enter my opening bid roundtable with all the answers. I know they have them. We have Slate Stone Wealth Chief Market Strategist Kenny Polcari, always a high-energy fellow on the table, along with Yahoo Finance's Brooke DePalma and Nez Ferre. Kenny, coming to you. Loved your note this morning. You said the bull market is durable. What is it making it so durable right now?
Well, you hit the nail on the head in your opening statement, right? It's broadening out, right? We have tech, which is actually underperforming, yet we got industrials, you got SMIDs, you got transports, you got the equal weight S&P, all making new highs while technology is just digesting, right? It's not falling apart, but it's just kind of catching up with itself. And so money's looking for investors are looking for opportunities in different sectors, and you can see it happening across the board. Now, I highlighted some of those sectors, the best performing ones, and I understand we're only a week and a half into the year, but you can already see industrials, basic materials, financials, and healthcare all outperforming the rest of the market. And I think that's good, right? It suggests signs of a healthier market, not in a market where investors are running out the door because they're nervous.
Kenny, you think we're seeing lost in the sauce, and I think you touched a little bit about it in your note this morning, that we are seeing AI fatigue. We know all these stories. We know NVIDIA is going to crush it. We know Microsoft's going to report in a few weeks. Their earnings growth, double digits. They're doing great. There's no juice necessarily to squeeze out of these rocks.
Well, you know what? It's fatigue in the sense that they've had a big run. To your point, the story's not over. But look, we're in the middle of Consumer Electronics Week this whole week, and you hear it every day when you turn on the news. What's going on? You turn on the cable stations, whether it's Yahoo, whether it's Fox, whether it's CNBC. You're hearing all about what's going on out there in the Consumer Electronics Show, and it is nothing but exciting everywhere you look. So I think the AI story is just catching up with itself. I think it's going to start to once it's all settles down a little bit and it kind of digests, then we're going to start to see it take the lead again.
And as I love what Kenny's talking about broadening of the rally, and you and I were talking about that throughout December, it's good to see that moment is happening now, that people are remembering there are 493 stocks, other stocks in the S&P 500.
And that's,
yes,
and you see.
And other sectors besides tech. And if you take a look at the 3 trading days of 2026, the past 3, we have seen that the sectors that you guys have been mentioning, industrials have been rallying. You've seen other sectors besides tech taking the lead. And I will point out that also when we're talking about the Dow transports, which touched a new highs yesterday, we also have to note that we are seeing energy prices lower. You're seeing gasoline prices going into 2026. They are at their lowest level since March 2021. And President Trump, in a rally back in December, had said that his biggest priority is affordability. Of course, going into the midterms, this is something that is going to be played up more and more. These energy prices, gasoline prices, jet fuel prices lower, and this is going to be a tailwind for the economy as well.
Brooke, speaking of tailwind, right in your wheelhouse, the U.S. consumer, rates lower, potentially big tax refunds this spring. I cannot wait to hear from some of these early consumer reporters, whether it's Starbucks or restaurants in a few weeks. I think they're going to shout all these things out as potential catalysts for earnings.
And we're even hearing some positive reactions from the street right now. Oppenheimer upgrading McDonald's this morning based off exactly what you said. There's hope out there that this low-income consumer has increasingly been under pressure because of affordability. We'll have some sort of stabilization as we move into 2026. I know I mentioned it before, but instead of that K-shaped economy, analysts on the street, experts telling me that maybe we're in more of an alligator-shaped economy.
You're still in that alligator economy call out, Brooke.
I loved it. I loved
Dig
it, Brian. I mean, the bottom of the K maybe moving up just a little bit, that low-income consumer getting some boost from these tax returns, and that was largely what Oppenheimer said within this note. Could these further tax refunds really fuel that low-income, middle-income consumer to return to some of the spending that they haven't done in quite some time? They also cited within that note that McDonald's could also see a return because of the fact that there's this regained momentum about what they're doing about value and finding the right price point to get these consumers within the door. And that's not only the hope for McDonald's, but also fast casual players as well, like Chipotle and Cava.
Kenny, let me get back to you. I will not, if you want to comment on the alligator economy, you're more than welcome to. But like, what could go wrong this month?
I want to make one comment about what you said. Lower rates, the Fed's going to cut rates. Don't expect Bloomies and Saks and the rest of them to lower their credit card rates. They don't. So the consumer is not going to get any help.
That's just messed up, Kenny. That's messed up, man.
Tax refunds. Right? They may get help with tax refunds, but you don't think Bloomies is going to jump in and help anybody out. Now, that being said, what could go wrong? Well, there could be a lot of things go wrong, right? You could get an earnings season, which is expected to be fairly robust. That's going to start next week on Tuesday with the big banks, and the banks are supposed to be having strong earnings. That's the expectation. But if we start to see any sense of weakness or any kind of cautious guidance going forward, that could start, a little bit of a pullback, right? That could go wrong. You could get, more commentary out of the Fed. I saw Stevie Mirren on Fox yesterday telling Maria Bartiromo that we got to cut rates by another 100 basis points. I'm sitting there thinking, what is this guy looking at? The economic data does not demand that. Yet, the market, they keep talking the market into it. So if you start to get pushback that maybe they're not going to cut rates, and trust me, I don't think they're cutting in January, and I don't think they're cutting in March. And I think the market knows that. But if they start getting a hint that they're not going to cut in May, then that could also disrupt it. And the third thing is going to be the midterm elections. Look, the whole House is up for grabs, right? 435 seats is up for grabs. And so there's going to be a lot of new names on the podium there. Where do they stand? Are they left? Are they right? Are they medium? What does that mean for policy? And so that could cause some short-term chaos.
Well, Kenny, that brings me to another point. Is the market pricing in a big year for the Federal Reserve? More rate cuts, new Dove as Fed chair. We're going to cut rates. We're going to get more consumer spending. The Dow's going to go hit 60,000.
Listen, the new Fed chair for sure is going to be dovish. We already know that because they're going to be in Trump's pocket and he wants to force rates over. But there are 3 or 4, maybe 5 current voting members that are in this camp going, well, slow down a minute. We don't really think we need to cut rates. Because remember, they can cut rates. They risk igniting the fire under inflation again, which is where they do not want to go, in my opinion. So I'm in the camp that the Fed should do nothing. I think rates are good where they are, neutral based on the economic data that I'm seeing. If Stevie Mirren and the rest of them are looking at a second set of data and they're playing I Got a Secret, I can't help you. But based on what I see, I don't think they should be cutting rates at all. But I think the market is expecting 1 or 2 cuts just based on the rhetoric and the narrative that they're pushing.
And Inez, as we're watching stocks move up and to the right, Bitcoin is finally getting some love again.
Yes, Bitcoin has been seeing a bounce, and strategists are expecting that you would see a bounce this month. You had 3 straight months of losses. So that sets Bitcoin up for a nice bounce into this month. There's some divergence as to whether the rally will continue through the first half of the year, but you have strategists that are pointing to higher Bitcoin prices by the end of the year, whether it be 115,000 targets or even 150 targets. So there's divergence on those targets, but certainly you are seeing Bitcoin and some liquidity conditions that have been improving crypto in general.
Brooke, I'm still waiting. I did a check. Like I mentioned at the top of the show, lower rates theoretically should help the housing market come the spring. We're still not getting a lot of movement. I look at the home builder index XHB. That's not doing much. Home Depot Lowe's not doing much. I was a little surprised by that.
Brian, to be quite frank, I think that this catalyst that everyone's been waiting for within this home improvement retailer, home builders sector just hasn't quite hit yet. And now, as I mentioned before on the show, is that now the rhetoric is sort of changing. Instead of these consumers or Americans moving out of their homes, maybe, increasing size, now the name of the game is renovations. Could lower interest rates push consumers to take on loans to ultimately build their house into what they want it to be, instead of taking on that 6% mortgage rate after they've had 3% for a number of years. And that's what Lowe's CEO told me earlier, or rather last year. We also heard similar rhetoric from Home Depot. And I think that catalyst that everyone has been waiting for, now maybe it's a turn of the tide here. Maybe now Americans are just thinking differently about how they're going to take on this housing market. I mean, even the conversation that we had before, this is going to be a key issue heading into the midterm elections, affordability around the housing market, and what exact candidates are going to say about that. That really is going to persuade Americans and their voting power, but also how they're thinking about the state of the economy, because they frankly just don't feel confident enough to move on their homes and take on higher mortgage rates, but also perhaps the renovations that come with a new home.
Kenny, you've seen a lot of stock market records, a lot of them spent on the floor of the New York Stock Exchange. When you see a round number crossed, in this case, Dow 50,000, we're on the cusp. Does that mean anything to you? Should it mean anything to investors? Do we care about this?
No, listen, it's a big round number. It's going to be very exciting. Like S&P 7,000 is going to be the same thing. The Dow 50,000 is clearly going to be kind of a bigger celebration. But the truth is, it doesn't really matter to investors. It's great. It's going to be a reason to celebrate. Everyone's going to point to the fact that look at how strong the economy is. But in the end, it's just a number, right? Exciting, but it's just a number.
Lastly, Kenny, at this point in time, just given the momentum in so many other areas of the market, do you use the Mag 7 weakness as a source of funds and look for more opportunities on those 493 other names?
So I wouldn't use the Mag 7 weakness as a source of funds, because I think the weakness is temporary, right? So I'm not selling any of my Mag 7 names at all. I'm just taking new money that I'm adding into the portfolio and using that as a source of new opportunity, right? I love the tech space. I'm not selling the tech space. There's no reason to it. It's not falling apart. This small little pullback of 1% in the Mag 7 means nothing to me in the long picture. Remember, I'm not a day trader. I'm a long-term investor. So that is not a place where I'm going to go to raise money to reallocate. I'm taking new money to reallocate.
Kenny, at your Dow 50K party, what are you going to be serving? What are you cooking up?
I don't know. Maybe a nice ossobuco works.
Ossobuco.
Listen, Dow 50,000 and ossobuco. Good. Sounds good to me.
All right, we'll drop the mic there. Invite me over, baby. That's what I'm talking about. Appreciate the opening bid roundtable. Y'all are the best. Coming up, you have forgotten about one big asset class, and I don't even know why. We kind of just talked about it as a little clue here. More on this one straight ahead. I love the start to any year in my field. Every year, consistently, folks in the street combine lists on unloved stocks or secret names you must own. Without fail, this happens. My colleague Julie Hyman loves these lists. In the spirit of this lunacy, I have one asset class that went a little forgotten in late December that is proving 7 days into the new year it shouldn't be forgotten. I will give you a clue on what it is. It was created by Satoshi. Give up? I know you do. It is Bitcoin, friends. Bitcoin prices have rebounded to start the year after trading in a tight range following sell-offs in the fourth quarter of last year. Forced liquidations and selling by long-term holders pushed prices down as much as 35% from the October highs. You know who hasn't forgotten about Bitcoin? My next guest, John D'Agostino, Coinbase head of institutional strategies here. John, good to see you again. Good to see you live in person. Appreciate it.
Always love coming to see you.
So at its very simplest level, what is happening in Bitcoin? Help us understand this mini rally.
Sure. So I can understand why people think it's happening suddenly, kind of post New Year. The reality is, Bitcoin has been quietly recovering since a liquidity crisis around the early October. Now, liquidity crisis in cryptocurrency is a bit different from other markets because, unlike equities, for example, the market makers, the participants who usually buy and sell and bridge liquidity, they're not obligated to post bids and offers like they are in equity markets. So commodity markets and crypto markets are similar in that way. So on October 10th, we have what we call a liquidity crisis, which means people got scared. They got scared they were overextended on their balance sheets, and they pulled liquidity away. They just exited the market. And when that happens, you tend to get these violent gaps down in price because people are very, very scared about not being able to get out of their positions, and they'll sell at any price. That happened. It happens you've heard of flash crashes in equity markets, right? That's the equivalent.
I've tried to forget those, but yes.
Right, it happens in all markets. When it happens in markets like crypto and commodities where the market makers are not obligated to be in the market, they tend to be a little more severe. So that happened on October 10th, and it was scary. Here's the good news. The good news is you didn't have this rapid, violent unwinding. There were these support levels of institutional buyers. So retail panicked a bit. They needed to get out, but institutional buyers kept that foundation. Now, it was reported that there was this horrible liquidity environment, and so crypto kind of fell out of the news cycle for those 2 quarters, and you saw this sort of grinding down, sideways movement, boring price action. What was happening for those of us who kind of stayed active in the market was we were a bit confused because you had this horrific retail sentiment. You had this crypto Twitter and just Twitter X overall just being very bearish on the asset class. But what we were seeing at Coinbase,
Jim Chano's tweeting at Michael
it's all over, it's dead, it's going to zero, everything.
I hear you, brother.
And that's fine. I actually like those environments because you get to buy cheap things that people forget about. But what was happening at Coinbase is we were noticing, institutions were just gaining interest. So that period from October to December was probably one of the most active institutional buying periods. And there wasn't a single institution that was looking at Bitcoin and crypto prior to October 10th that suddenly stopped because of October 10th. So there was this huge bifurcation of interest. You had massive institutional interest and horrible retail sentiment. And so what's happening is since October 10th to now is you're seeing a bit of a catch up of retail sentiment, recognizing that institutions are still building and still growing. So I think of it less as a short-term spike and more as a sustained recovery.
Someone that I know told me yesterday, they said, Brian, this will be the year of tokenization in crypto. When you hear someone say that, what does that exactly mean?
Yeah, so it's a bit of a buzzword, right?
It is very much a buzzword.
And so I think of it this way. So I'm not that old, but when I got started, my first job—
Not old, period.
Thank you. But my first job ever as a young kid at a business school was the floor of the New York Mercantile Exchange. And this isn't 1960, this is like 2005. And it was still a bunch of guys screaming and yelling and trading open outcry. And my first job was to help shift that to electronic trading. So just basically removing the physical floor traders and what we call going upstairs. So digitizing that market. And that took a decade to do. And so think of tokenization as just the next step in that evolution. So it's shifting from the current way in which we record these transactions to recording them on blockchain. Now, why is that useful? Number one, blockchain is just better technology. It's faster, it's cheaper, it's cleaner. But more importantly, you can inject code into those tokens. They become smart. You hear about smart contracts or smart tokens. And then you can do lots of really interesting stuff. For example, there's certain reporting requirements that happen when you own more than a certain percentage of a company. All of that can be automated. So tokenization, it's not a scary technology. It's just simply that better way of digitizing that transfer of value across capital markets, whether it's equity, credit, commodities, crypto. Coinbase is kind of showing that now. Our new everything app, Base, allows you to trade all those different assets on one platform. Now, why is that useful? Number one, it's convenient. Elon Musk likes to say the most entertaining option wins. He's a very smart guy, but I think he's wrong there. I think the most convenient option usually wins. And so how wonderful will it be if you can log into one platform and you can buy everything from a prediction market on real estate to Bitcoin to a tokenized equity all in one place. not only is it convenient, it can be cost efficient, because over time we'll figure out ways to cross margin all of those assets. And when you cross margin assets, you have to post less margin as collateral. That saves everyone time and money.
If we're having this conversation 2 months from now and Bitcoin's back at the highs, what will have been the biggest driver of that happening?
My interview here.
Of course, right?
So I think
Buy now!
There's no, again, we love to ascribe, humans love to ascribe causality, correlation to causality, or confuse the two, I should say. So I think it's all the same things that's made Bitcoin valuable over the last 17 years since Satoshi wrote the original white paper. I won't hedge on this answer. To be more specific, in this current environment, it's going to be regulatory clarity, particularly if the Clarity Act does get passed. But even if it doesn't, I think we have an SEC and CFTC that's never been more innovation friendly here in the US. It's going to be continued regulatory clarity. It's going to be the retail realization that this institutional adoption at both commercial and government level globally is, the train's left the station. There's no going back. It's that. And then I think it's a stabilization of these market makers who went through a pretty scary period on October 10th. But the good news is, what we didn't hear this time, unlike prior flash crashes in crypto, there was no major insolvency. There was no FTX. Because these market makers, these big institutions, while they got a little bit wobbly that day, they were risk managing properly. So the realization that the market infrastructure has kind of grown up a bit, and the probability of a large scale insolvency, I think, has gone down. All of that creates confidence in a high quality technology. People buy it, price goes up.
Always good to see you, John. Tell the Coinbase team I said hi. Appreciate it.
Thank you.
Thanks so much. All right, coming up, Julie Hyman will stay on the pulse of stocks and maybe even some crypto on Market Catalyst. We'll be right back.